Hello and welcome to Moneycontrol's Private Wealth Roundtable. This is a this is a series that we are starting this Diwali. First of all, wish you a very happy Diwali and a very profitable new year from here on. The stars are aligned right here at Money Control and on your screens, and I'm joined by the people who help rich grow richer, the private bankers and private wealth advisors, the top guys in this country. Ashish Gumasta, founder and CEO, Gumasta Partners. Feroz Aziz, joint CEO, Anand Rathi Wealth. Lakshmi Iyer, Group President, Investments for Bajaj Finserv. Rajesh Saluja, co-founder, CEO and MD of ASK Private Wealth. Umang Papneja, CEO, Julius Bayer. And Yatin Shah, co-founder and joint CEO, 361 Wealth. Gentlemen and the lady, thank you so much for joining me this morning. Wish you all a very happy Diwali first.
Happy Diwali.
Wish you the same. Happy
Happy
Diwali to
Diwali to
everyone.
you.
So, these Zoom discussions tend to be slightly animated in the sense that each one gets a chance to speak, and that's how conversations progress. But this year, I'm pretty sure that opinion is divided in terms of who goes where, and therefore I would encourage all of you to really interject. And if you have any difference of view, please try to interject, and let's have a more lively conversation. So, the first thing, probably I should start with Ashish, is that this year it looks like everyone in the sense all asset classes are on one side and Indian equities have been on the other side. The only asset class that has not performed this year is Indian stocks. You look at gold, you look at silver, you look at international equities, you look at US, you look at China. Every single asset class has done well. It's only equities that has been completely flat. um, First of all, how do you decode this? How are your clients looking at this environment? Do you see this as a continuing trend? Where do you see reversals?
Thanks, Mahalakshmi. Am I audible?
Yeah.
Perfect. Hi, happy Diwali to all of you. So what we've seen is we had 2 or 3 really good years in the equities, and this is a year of consolidation. Earnings, kind of markets ran ahead of valuations, and if you see, we've had record IPO issuances, so a lot of money has gone into the IPOs. I think this year the amount of profits foreigners have also taken out is phenomenal. So the last challenge which we had was the US action on us. But what it has forced the government to do is to come out with a series of reforms. And post Mr. Modi's coming back, I think the last couple of weeks has seen the real intent of government of coming out with the reforms. So I think the coming year will see a huge effect in terms of earnings. I think will now be in double digit. There will be a multiplier effect of the benefits the government has given, and probably you'll see a huge pickup in consumption. The nature of consumption also is changing in India. It's now more discretionary in nature. So I think overall, this was a year of consolidation. This was a year of IPOs where corporates raise money. But the coming year is likely to be a year of equities. So while traditionally we were recommending clients into balance funds and hybrid funds, I think this is going to be a year of flexi cap.
It's a flexi cap, but you are certain that the equity returns start to become positive from here on.
The risk is,
if you
of course,
look at it from a 1 year horizon, and everybody says that let's not look at 1 year, let's look at 3 years, 5 years, fair enough. But what is a reasonable guesstimate in terms of what we could do this year?
So likely to be positive. Your only risk is if something goes wrong in the US. That is what we started the call, right? So US seems to. Yeah, please.
I was just adding to you when I heard the name.
Yeah.
I think surely the valuation and earnings led to the markets taking some pause, and of course the kind of selling which we have seen in FIIs, they definitely took some profits up. So if you see last 12 to 15 months of buying from domestic mutual funds and retail investors, and exactly amount of selling which came from FIIs and IPOs, there was no incremental money which actually went into secondary markets, right? So definitely there was one absence of buyer uh, for markets to continue the momentum which was having. Secondly, I think relatively from valuation perspective, I think everything else looked more attractive. So some bit of money did get reallocated out of India. Going forward, I think the earnings seems to be looking to pick up. I think earnings have not picked up. I think last 4, 5, 6 quarters we are still under 10%, and that's where I think somewhere the markets are running ahead of earnings, and somewhere earnings are ahead of the market. I think next couple of years one should expect some reversal of trend. But nonetheless, I think I would say that the the way momentum had, I think everybody was doing well. I think last year was more about stock pickers, active fund managers. So definitely there are few funds do stand out which have given more than 15% return. And I think when this market takes pause, consolidate, you clearly can see the distinction on your active market selection of some good fund managers and so on and so forth. But going forward, it looks definitely, I would say, move the stance from neutral to slightly overweight for Indian equities.
Fair enough, Yatin. So whenever we talk about equity prognosis, we're always looking at valuations and and earnings to determine where markets are headed. But the fact is also that investor behavior counts for a lot. And what we know from investor behavior is investors do chase performance. And year, if anything, looking at the skyrocketing returns that gold and silver has given, of course, in the last 1 or 2 months itself, you've seen this huge inflow through ETFs. There could be, would you suspect there will be a tendency for investors to chase performance even more, which means what probably the rich investors or your clients may have figured out some time back, that gold is in a bullish zone, could now get percolated to a larger section of investors who could again shift to other assets apart from equities, just going by the sheer contrast in performance this year. Firoz, you want to take that?
Good morning, Mahalakshmi. I think, of course, like you rightly said, people have this tendency to chase performance. But when they chase performance, they also get, in a rally of this kind between gold and silver, of course, in terms of dollars, we've seen one of the largest technical rally. Basically, all the possible resistances are broken. So I personally think that it's not the best time to buy. Of course, the temptation, your heart is going to say, why don't you buy something? FOMO is definitely an emotion which is not ignorable. Recency bias is going to be taking over most of the decision making, which is what has happened when you're supposed to buy an asset, most people will be selling it. So there will be a lot of net flow from an Indian context perspective to the ETFs. There's no taking away from that. But I personally think once the rally stops and there is some sideways or a down movement like you saw over the weekend, I think the flows will become a little more reasonable. One. Two, what do you expect of these asset classes? I personally think on a 5-year rolling basis, median plus returns on equity is possible. Like Yatin was saying, choosing right fund managers can get you those 3, 4, 5, 7% excess returns over Nifty. So the probability of gold giving 15% compounded 5 years out is significantly lower than good fund managers giving you 15% compounded, which is twice the money in a period. So yes, net past performance will be chased, but this time not for too long, because this kind of rallies don't linearly go up. So if there are reversals in the next 1 month, you would see flows stopping.
Umang, what do you see? I mean, is sentiment decisively in favor of equities now? Do you see more and more, even amongst the high net worth individuals and the rich clients, do you see some tendency to move a significant part of their assets? And I mean, significant means it could go up from 0 to 10 is also very, very significant. Could that happen? And what is the chance or likelihood that some money moves away from equities just by sheerly chasing performance?
So, yeah, happy Diwali, Mahalakshmi. So, when you say movement away from equities, did you mean into gold and silver, or was this to some other asset class? Hello?
in terms of what you can take money out through LRS, etc. But
Okay.
my understanding is that a lot of rich investors are also looking at other kinds of options to make move money out in terms of diversification and so on. So bulk of that part, how do you see the sentiment and tendency for them to overweight or underweight local stocks?
Sure. So, talking about international investing, of course, there are three ways to do this. One, of course, is to do it through local feeder funds which feed into overseas investments. Second is your LRS. And both of these have limited kind of reach. So, for instance, the local limits of $7 billion are almost over. So, only a few funds are available for fresh purchases. Second is on LRS. I think the total market size, because you're constrained with that 250,000 per year, that also is limited because people do use it for other purposes like education, travel, etc. So you have far lesser to kind of go and invest from that. Third, now a very, very strong source or strong pull for international investing is coming through the gift city. Now, what the government is allowed or the rules allow you is that around 50% of net worth, if you have a corporate or an LLP or a partnership, can be sent into gift city. So that is, of course, now you're suddenly talking about a larger market because few corporates or few LLPs can have significant net worth and go way, way beyond the 250K mark. And that is now starting to see traction. And we are having a few funds in the gift city, although it's very initial stages and people are getting used to this kind of route. Uh, People know which bankers to approach, which AD banks to approach, and all that systems are now getting in place. So that we've seen around maybe $500 million, closer to $500 million going into international investing through gift city. And I think that can only go up from here on as more and more people get aware of this route. Second, of course, now about your gold and silver question, I think I kind of agree with what Firoz said. So anything which has gone up 50-60% in a year requires a little bit of breather. But the trend, as more and more central banks keep buying gold, not that much particularly silver, but gold definitely, I think we would still be in a positive trend. But anything goes up 50-60% in a GFI needs to be kind of taking a breather for some time. But let's wait and watch. Yes.
Okay.
Back to you.
Rajesh, what is your take both on precious metals and also on, how what is the sentiment like amongst your clients?
Right. So sentiment remains strong, at least related to investing in India from a longer term perspective. And I think, like everyone mentioned, equity last year has been flat. Some funds have done well. Some active managers have delivered 10 to 15 odd % return. But I think the way people are seeing is all the actions taken by the government. You've got tax breaks that should play out this earnings season. You've got GST cuts. You're already seeing last month both auto and consumer durables, have shown strong sales. So that's looking good. There's payroll commission that plays out towards the end of the year, and then of course interest rates. Belief is both in the US and India should see further rate cuts. So we believe that active managers will be a better play going into next year. And while earnings growth has hardly been 8-9% for this year, again, the estimates, and I don't know how far those estimates come true, but now again, we are talking about a 15% earnings growth next year. So equity from a one-year perspective is looking strong. We've gone overweight as compared to being neutral from a one-year standpoint. Joker in the pack is, of course, the US economy, the little bit of overheating, some bubbles here or there that get formed. And if that were to have a reversal, then short-term liquidity could be impacted. But otherwise, from just pure fundamentals, in India from an earnings standpoint, government's fiscal position, monetary acts, both here and globally, all augur well for better equity performance. With regards gold and silver, it's largely gold. Silver is, we all know, is linked to a little bit of industry boom, be it EVs, data centers. Some of those are driving silver prices and a little bit of speculation. But gold for the last 2-3 years has been something that is a part of every client's portfolio, largely due to geopolitical risks, a little bit on US dollar and generally inflationary environment. So it becomes a natural hedge from a longer term basis to have in all client portfolios. So gold is something that is very, very actively recommended in portfolios. Given the current run up, some 30-40% return in the last 1 year, we are advising clients to be a little careful, wait out for the earnings season, wait for the next 1 or 2 months, and then through an SIP route, one could still take portfolio allocation up to 10%. But when you look at ultra HNIs today, I think given where the markets were, equity markets remaining flat, barring a little bit of investment in gold and silver, I think smart money is really moving into the new sectors. There are some very good opportunities on the private credit space. There are some good opportunities in new age businesses around data centers, blockchain, defense. So we've seen a lot of money moving there. You have to be, of course, selective because there's limited data available to take the right call. But we've seen that as something that ultra HNIs have really been keen to invest in, along with real estate that witnessed a cyclical upturn and now can increasingly be played through a combination of REITs and InvITs. So that's really where smart money is going and our clients are investing.
Sure, sure. I'll come back to this portion on real estate and REITs. But before that, Ashish, how do you see the general sentiment amongst promoters? Because for a large part of last year and actually 2-3 years now, there has been unrelenting selling from promoters. Of course, the argument is that there is so much appetite from domestic institutions. Where does this promoter stakes in India are anyway way too high, and this is a transition that is supposed to happen anyway. But everything in the end is a question of valuations. If people see that they're going to make a lot more money on whatever stakes they have, they would much rather hold on than to liquidate. Incrementally from here on, do you see promoter selling receding, or do you think people who have not sold as much as they would wish to sell, even if markets were to be flat, they will much rather sell, because a lot of IPOs today may be getting lower valuations than what they would have got in September 2024 or before that, but they still come out with it knowing that today's reality is this and might as well go to market now than to postpone it even more.
So Malakshmi, the promoter sentiment is very positive. There's a major wealth effect. The wealth effect which they face because of the valuations going up has been a big advantage to them. There are three things which I find promoters doing. One is they are looking at investing in these new age businesses, which is AI, defense, robotics, as Rajesh mentioned. So a lot of capital is flowing there, and that is why there's a lot of interest in the private markets. Even a lot of this money is moving internationally because these opportunities are not available in India. So that's the first big shift which is happening. Secondly, they've now started believing in the India story. Previously, every time we felt the market would go up, again things would go down. But it's the first time almost every promoter that I know believes in the next 10 years of India story. So this kind of optimism I kind of haven't seen before. And third is now the ability to take risk has suddenly gone up because there are 1 or 2 or 3 or 4 zeros which has got added to their net worth. So the ability of the Indian promoter to take risk has really gone up. So in a way, we are like the US of the 80s. So I think you'll see a major, in the next 5 to 10 years, you'll see a major change in the structural nature of our economy. So I mean, that's broadly what we are seeing. On investment side, a lot of them are going international to diversify their investments. So like Rajesh mentioned on the upcoming opportunities which are coming in, those sectors are not available in India. And like Umang rightly said, that you have these three routes available. For the ultra high net worth, they also have the NBFC route, which is available, through which you can diversify your portfolio. So using a combination of this, wealth is going abroad, but it is going with an objective of diversifying and investing, and not how it used to be historically. 30 years ago, wealth used to go overseas for wrong reasons, but now it is going for the right reasons, whereby promoters are planning to expand, grow, diversify their business.
In fact, I just wanted to
Fair
add
enough.
one point to what Ashish
Yeah.
was saying on the IPOs. So the difference between, say, what was going on in 23 and 24 and as compared to now what's happening is most promoters have realized that there should be something on the table when the IPO comes. So you're seeing a lot of IPOs coming at a discount than what they were trading at in the private markets. And that's a huge difference between what was going on in, say, a year or two back. We've seen a few companies coming at a huge discount to what they were just trading a month ago in private market. So everybody wants to leave something on the table for the retail investor, and I think that's a very, very good change.
Fair enough. What I'm hearing from everyone again is, correct me if I'm wrong, and I do want somebody to
who are
speak
conscious
counter to
about
what
it or who probably
is that,
understand the current business environment they are in. But largely, IPOs, tend to come out during very strong bull markets, and that trend continues even this time. Now, as Ashish was mentioning, are they utilizing the money for the right reason? So clearly, at least from the promoters we see, they are. It's releasing crucial risk capital for further growth, especially when they are reinvesting in new or existing lines of businesses. And the very fact that the Indian market has been able to absorb so much of promoter offloading, along with FI selling, by the way, it just shows the resilience, the liquidity. So, promoters, if they use it well, it works fine. But if there are, of course, in bull markets, promoters who also misuse it, and that's typical, and we have to always be careful what kind of IPOs we are advising our clients to remain invested. Many are seriously overpriced, and we've seen the trend that after a year, 2 years, many of these IPOs prices don't hold, and clients can buy into good quality businesses after having enough and more data for at least 1 year on how that business has performed at a much more reasonable price over a period of time. So our advice right now is to be extra careful on IPOs, and the better value available in listed equity rather than trying to chase some of these IPOs at crazy valuations.
Fair enough. So, point well taken, Rajesh, yours and Umang's also. The point I'm trying to get a more pointed answer to is what I hear from all of you is that private money, that is like we're not talking about the SIPs, we're talking largely about the smart money, the richer people, the promoters. A lot of that money came into secondary markets till last year. And the sense I get is, and which is what all of you are also suggesting, is that money is now going into private credit, private equity, venture capital, newer areas of which you don't have too much available on the table in secondary markets, and if it is available, they're fairly expensive. And then there are all these opportunities in international investing. On top of it, there is also allocation to gold, which is going from the same kitty. Where does all of this really leave secondary markets? It is one thing to say that secondary markets are resilient because they are able to cope with all this. Another thing to see secondary markets will gain from here on. Today, there is the risk facing secondary markets or secondary market investors that markets could actually go sideways for a long time. It may not correct or crash like we used to have in peak market cycles earlier. But what is the likelihood that it will just sideline because there is so much more distraction and so many other opportunities coming up?
So, Mahalakshmi, I don't think there's an issue on clients just going after one specific asset class. I think people who've been investing, and especially with wealth managers like all of us, understand the concept of asset allocation. I think many learned the lessons when they were overexposed to real estate over a period of time. So, are they remaining invested in equities? They are. Some of the money may, will be getting reallocated into international gold, real estate, etc. But it's not that people have stayed away from equities. Plus your domestic flows continue to be $40-45 billion, right? But also having said that, ultra HNIs are smart enough to understand whether there is fundamental changes in earnings. So everyone's watching what happened in the first 2 quarters. The moment there's a pickup in earnings, which is expected in quarter three, quarter four, given all the stuff that we spoke about, GST, tax cut, interest rates, etc., you will see money coming back into Indian equities, and smart money or underallocated clients who are underallocated to equity or took a underweight call over a period of time are slowly but steadily buying into good businesses. So it's not that the secondary markets are not moving anywhere because the ultra HNIs are not investing. It's largely to do with fundamentals and earnings, and people who are smart enough waiting and watching to see a change.
Fair enough. So incrementally, you think that money will come into secondary markets? A larger part of the incremental flows will chase secondary markets this year. Will that be fair to say?
Of course. I mean, the tariff stuff that is going on hopefully should get settled soon. You're seeing both the parties making, efforts there. I think the first boost will come in once this whole tariff part gets settled. After that, then, the earnings, if quarter three earnings pick up, and, there are many sectors that are already looking very promising, where stocks haven't moved, but earnings have been steady, and you're already seeing a change in quarter three. So a combination of these factors, overweight calls will largely be taken, I guess, after a little bit of this tariff thing settles down.
So just coming to the point on allocation, actually. So I think when you mentioned about smart money, wealth managers, I think at any given point in time, all of us are looking at where is the fundamental supporting a return expectation, right? So I think the portfolio allocation keep changing. I think we see some of that trend um, coming up in international markets. If you were to give me relatively, I think emerging markets and China, Europe financials, some of that is looking very exciting. And Umang kind of added that there is now largely three routes where you can start investing. So when you look at the bucketing for and smart money or ultra HNI investors, I think at any given point in time they have a certain diversification strategy and certain return expectation when they are allocating pool of capital. So when the secondary market discussion, of course, when you're having it, I think it have to come back to that attractiveness when you can earn that 15% plus return. So when some other asset classes do allow you to allocate that capital, the money moves out of it. I think some of that played out last year. I think some of that will continue to play, like international market, secondary market is looking that it will give you a 15% return. And that money should come back, which left for some other asset classes.
And what Mahalakshmi, I think
I'd like to
most
add here.
Oh, sure. Go on, Feroz.
Sorry, Umang.
No,
So that is one hypothesis. Is the smart money truly smart money? Or it is actually relatively worse off than retail? So I did a study. Every time markets are low, like last month, the net flow, if you remove the SIP, was 1,000 rupees in equity mutual fund category 3 of AMFI. They categorize. Markets, when they're low, HNI is selling. And when it is high, HNI is buying. So is HNI money the smart money? If you look at FY21, which was a year when Nifty averaged at 10,732. That was the average Nifty for the full year. HNI sold close to lakh and 26,000 crores of equity mutual fund and a couple of lakh crores of PMS. In the same year, HNI's retail bought 94,000 crores. So the point I'm trying to make is when values become larger, people's recency biases become very, very strong, because if somebody's got 20,000 rupees, if it falls 1,000 rupees, he's not so emotionally driven. That's point one. Point two, if you expand this hypothesis, you will see in assets, HNIs enter after recency bias. Coming back to your pointed question, Mahalakshmi, what kind of monies can come into secondary market? I've tried to do some statistical projections of those. From FY21, about 15.5 lakh crores has come from domestic institutions. The next 8 years number would be 54 lakh crores minimum from domestic institutions. In the same period, FIIs have sold, net have brought in zero in the last 4.5 years. DIIs have brought in 15.5 lakh crores. The previous 8 years, DIIs just brought 3 lakh crores. So if you do any mathematics, because when the numbers of SIP were 9,000, I projected 25,000 for a 3-year number. So you're looking at least in the next 2 years, you're looking at the SIP number reaching 48,000 crores. If that's the hypothesis, if that's true, then there is a lot of free float to be absorbed. And I'm glad that promoters are selling, because 90% of S&P 500 has 90% free float. And for S&P, for NSE 500, only 6% of NSE 500, which is 31 stocks, are upwards of 90% free float. And if you look at the MSCI India Small Cap Index, which has about 524 stocks, the total free float is 34 lakh crores of those 524 stocks. So point I'm trying to get to is there's going to be more demand than supply from domestic institutions. And if risk is all about 20% falls, I don't see that happening. If people think 10% fall and a sideways movement of a year is risk, then surely there is enough risk. And that's why you are remunerated twice more or thrice more. In fact, in an FD, 1 crore becomes 2 crores in 10 years, and in equities at 15%, they become 4 crores. So it implies that if you're going to make 3 times more than what you make on an FD tax efficiently, you are going to be withstanding some degree of pressure of 1-2 years. And if you're not prepared for that, you're not meant for equity yet.
And that's quite a bold statement to make, that smart money, challenging the hypothesis that smart money is smart money indeed. How do you counter the fact that during COVID, I think the quarters immediately before after COVID, the maximum buying was from promoters? And in the last 2 years, when markets have sort of paused and gone sideways, or even during the highs in the last leg, promoters have been the biggest sellers. So,
no,
they're two separate things.
So that's smart money. I mean, that's what makes us so excited about the size of the opportunity in wealth management, because clearly there are many HNIs who need to be, handled by professional wealth managers, and a concept of asset allocation is put in place. At least what we see today, the HNI stroke ultra HNI that wealth managers are managing, we are able to guide them to actually take advantage whenever things are bad. So smart money, which is, I would say backed by a little bit of experience and financial literacy and good temperament, takes advantage and keeps investing during tough times. But yes, there are lots of investors who, just from a behavior standpoint or temperament standpoint, tend to get excited about equity markets only when they are very high, be it retail or HNI. And I think that's the single biggest opportunity for professional wealth management firms.
So it's not a bold statement, Mahalakshmi.
You were about to say something, Feroz.
See, it's not a bold statement. It's a mathematical statement. List down the 10 assets which went through a swing, and preceding that, who has bought it. It's very easy to test this hypothesis. I've tested it, so it might sound bold, because if you look at NASDAQ, did very well 4 years back. Right, people, there was one fund which I remember was a NASDAQ fund, which was 800 crores, and it did 53% return on 800 crores. Then that fund collected 9,000 crores of net flow, and the subsequent year was 25% negative return. And then there was a net outflow of 6,000 crores. So if you just test this hypothesis mathematically across assets which have seen swings, you will realize that's not a bold, it's a mathematical statement to make, especially when I'm in the business of trying to interact with HNIs. It's a risky statement, if not a mathematical. That's point one. Point two is...
True that.
If you look at, Mahalakshmi, I have seen so many retail portfolios who have a better risk-adjusted return than a 100 crore portfolio. I'll give you an example of a 100 crore portfolio. Has 70% in debt, 30% in equity, 70% in debt, 30% in equity, has everything under the sun, unlisted, global equity, private credit. But he or she could have achieved a better return by just changing the asset allocation to 34-66. So point I'm trying to make is there's so many fancy things an HNI does, which may or may not be right for him. So that's why that hypothesis was tested. So you can change asset allocation and get 0.5% more IRR than indulge in things which are newer variables to enter your portfolio. That's a suggestion which I leave on the table for most HNIs.
Fair enough. Sorry, anybody wants to add to that?
See, Mahalakshmi, tax plays in the mind of everybody, and debt is taxed at marginal rate. So till debt is taxed at marginal rate, money will continue to come into equity. Firoz's assessment is right that we have this FOMO effect in India, and that FOMO effect is happening where money is chasing opportunities. I mean, like Rajesh rightly said, every month there's a new wealth management company also coming in. But the only one worry which I have at the back of my mind is from COVID days, we haven't seen a correction. So it's just been a one-way rally. We've had a time correction. So a lot of the new investors who've come in, 70-80% of the new investors have come in, feel it's a one-way street, you know. So 10-12% return, a time correction is actually good for our markets. It's very healthy for our markets, you know, rather than having a sharp correction. If we have a correction, Feroz has already given us a perspective on the money coming in. One piece which can play out this year is the FII money coming in. If FII come back, then it can be a full. They've been selling in the last couple of years. That can be a new source of capital which can come in.
And what is the likelihood that you see again the IPO pipeline for the coming year also is extremely strong? And even if you look at the FII flows, they've been largely sellers in the secondary market, but I think they've what about 50,000 crores of IPOs this year itself. What is the possibility that sort of the IPO markets steal the show and the secondary markets don't? Because even if you look at the valuation pyramid now versus last year versus the peak of last year, that is September 2024 to September 2023, I think if I'm not wrong, we did this chart where we were seeing the number of companies that now trade at 0 to 25 PE, although PE is just a rough and dirty number. Not more than 10% are actually cheaper than 2023. So it's not that markets are remarkably cheaper, exactly for the reason that you mentioned, Ashish, that we've not seen a significant correction. We saw a 14% correction on the index. All of it has come back nearly.
So, you over exerting on secondary market. I think you have to look at everything what's happening. You have to look at how the flows in international markets are increased. What's the current AUM in GIFT City? What's happening on the alternate Cat2 funds AIF side? What's the total size of the commitment which has committed by the ultra HNI investor? What are new regulations in coming for co-investing SIF? Um, I think the market will remain. I think there are 2 or 3, 4 trends which we clearly see what's happening. The first is, I think, the gold silver trade is not just the trade for it's a trade which is technically US dollar weakening which is taking place. There is surely the tariff situation, debasement of currency, geopolitical risk. All of that has led to some of the usual investing trends which are changing globally, right? If you see the net dollar, net dollar, for you remove India out of the equation, if you see the total dollar available for investors across the world, a large part of money went into US for investing. Some of that is now shifting. I think not that the money is moving out of US. I think what we are discussing, where are the new incremental flows which are going to go, and what are the markets which look attractive. There's some of the markets which got deprived of foreign capital, which is Asia, emerging markets, China. Some of that trends are getting reverse flow, and the cash subsequent to dollar depreciation is hiding its way into commodities, which is the actual trend. I don't think the correction and all of that will happen, but some of these trends, when they reverse, I think the trends continue for some time. I mean, the correction, volatility is all part of it, but I don't think the trend is changing. And India, in a way, I think seems to be in sweet spot. I think the IPO and the secondary market story will continue to play how the fundamentals play out. As the fundamentals play out for the attractiveness IPO will continue to happen. I think coming from Ashish's point, Umang's point, I think some of the past IPOs have left enough money on the table for investors to get attracted. the joker in the pack is, I think so far we've met domestic demand and the promoter domestic demand, and matching the promoter selling. The promoter selling could be your existing secondary offering or your QIB or your primary offering, or OFS from the promoters, but it's exactly matching the cash which is there in the system versus the FI and the promoter. Some trigger which could surely looks like an earnings trigger, which is now I think markets looking at a poise for earnings trigger, will I think drive incremental flow and drive the secondary markets return.
Just to add on Yatin's point on so when you look at the earnings numbers which are coming, so the earnings results have started. Now, I saw at least for the last few days there were some companies which came out with negative year-on-year growth. Right. Now, generally in markets, you would expect that the stock should go down, but what happened was the stocks went up. So what does that mean, Mahalakshmi? It means basically that the bad news, almost all of it is kind of discounted. We've not seen a behavior like this, that when you see a year-on-year growth, degrowth, and the stock goes up. That's point number one. Second, on your point is, where is this money going to come from? Will the secondary market get kind of ignored? But we are losing one very important point, which is consistently in discussion in client portfolio. So, for example, Firoz was saying that let's assume HNI was say 60% fixed income and 40% debt, or whatever the number could be. But what's incrementally happening is that we are not getting any more money in fixed income because of the taxation change. So all of this new asset classes and also equity is at the cost of fixed income and not necessarily equity. So we are seeing since the taxation changed, we're seeing this amount of fixed income gradually reducing because no incremental money is going into fixed income at all.
Adding to Umang, actually very good point. I think it's no more UHN as looking at a traditional asset allocation. It's actually you have your core portfolio and your alternate portfolio. An alternate portfolio could be illiquid, unlisted, slightly more longer term, and your core portfolio could be your REITs, InvITs, equities, and some bit of international equity, which is again listed liquid. So I think these buckets are shifting, and it's actually coming out of the lower allocation to fixed income. Fixed income has become like a safety pod. It's become an absolute amount of money, not a percentage overall portfolio allocation.
Lakshmi,
Yeah.
I would like Ashish sir was saying, this is very good for the market to go sideways. Like he was pointing out, valuations become reasonable over a period of time. One thing which, like you mentioned, right, you have to have the clarity that secondary market is very different than a promoter buying his own equity. Okay, buybacks by the promoter. If Mr. Rathi bought back his share, I would not call it a secondary market participation of some degree, right? So when you look at secondary market participation of people, if you look at the IPO market, you see the IPO market has a big challenge, that the volumes, like one of our businesses got listed, group company business got listed, the total number of shares traded on first day delivered is significantly greater. Now, it's significantly greater than 75-80% of the total free float put into the market. So what I'm trying to get to is, fund managers are capitalizing on IPO markets, high volume, and the retail behavior of buying it and selling it on first day. You're getting some businesses significantly cheaper, not because they deserve to be cheaper, but most people who got the allotments don't want to hold it for the long term. So that a fund manager is playing. So I personally think the IPO market is very good for a fund manager to allocate money when there is a retail guy who got an allotment, but he does not wish to hold. He's not wanting to hold. That's point one. Point two, if you look at how the earnings are to be computed. If you look at NSE, I was on a debate and somebody said Nifty ki earnings last year ki 6.7%. That's what NSE website will also help you backward calculate. But there are 4 changes in NSE Nifty 50. If you eliminate those 4 changes, actually last year's earnings growth was 11%, not 6.7. There were 4 businesses which were changed. You can't take one of our businesses and compare with the base of another business, right? All of us represent different businesses. If you look at NSE Small Cap 250, Okay, I was hearing somebody saying earnings INE last year. It shows minus 18% NSE small cap 250, but there were 63 changes in NSE small cap 250. If you undo those changes, earnings growth is plus 9%. So what people are doing is they're not dirtying their hands in doing the mathematics, and they're going by the narrative. Earnings have been not as bad. Okay, if you look at earnings of the free float, you will be very, very pleased. It's not so bad, and I think this year also you will look at an earnings growth on Nifty of about 11-12% for the year.
Fair enough. So another quick question on a new asset class that has now come up is this special investment schemes that mutual funds are allowed. How big a disruption can this cause to the AIF world? And how big can this category really become? Because it looks like this is going to be tailor made for high net worth individuals and ultra high net worth, and it has all the transparency and other factors that mutual funds offer. It has the tax advantage of not paying taxes on churn. How do you see this category? Is this going to be a really large category that will be disruptive for AIFs? How do you look at it?
I can go if everything is okay.
Please.
Looking at
Please.
looking at what's been happening from the initial launches, so there are largely two kinds of products which are coming in. One is, of course, a sort of fixed income plus kind of number, or some fixed income plus kind of launches, and then these are the second is, which is still coming, is the traditional long short coming on the SIF platform. I think it directly competes with category 3. So to your question about will it really impact a lot of AIFs, I don't think category 1 and 2 get impacted at all. Category 3, to some extent, the long short long short kind of funds get impacted, which was never a big category in itself in any case. So that a little bit gets impacted. And I'm quite positive on this SIF, this asset class or this category, I would say, as long as the tax benefits stay. Now, it's a question whether this tax benefits stay for a long time or not. But if they stay, it has the potential to come and disrupt and gather a lot of assets.
I think what can get
it's only going to expand the market.
Yeah.
It's going to
What can get
expand the size of that business. And earlier it was HNI, ultra HNI that was playing or investing through the AIF route. Now even retail participation can come in. So it's only going to make the market bigger.
No,
Otherwise it was.
I'm just asking, will the family offices and the rich money start to chase SIF as well? Because it's a far more tax efficient product.
Of course, and most people who run AIS will then move it under a mutual fund license. So it'll overall expand the market and make current AIFs relook at the vehicle under which they launch these schemes.
So,
I
Mahalakshmi,
think, but what can happen is
a lot of talent left organized. So Prashant left, started his own. Pankaj Tibrewal left, started his own. So I don't think the AIF, because a lot of talent is going independent, and we still see that trend continuing every month. Some talented person is leaving. So asset man, while mutual fund industry will have a separate asset class, but I think the AIF asset class will continue to grow. What Umang rightly said is the tax benefit is massive, which will help this asset continue to grow. But I don't think the trend which I'm seeing as I meet more and more fund managers, they have a desire to go independent. This, given a choice, they would want to do something of their own because they see some degree of flexibility. So I think both asset sizes will continue to grow. Feroz has given us the data, right, of the kind of wealth which is going to come into the financial services industry.
Fair enough.
I think
Now,
what looks
quickly
difficult
back
is
to you.
sorry, just adding to that
Sorry.
one point. Adding to one point, I think what looks surely disruptive because of SIF is the PMS. I think PMS do have a lot of leakages both in expenses, tax, all of that. I think that some of those strategies can surely move to SIF.
if you want me to comment.
Sorry, I'm not getting the audio connection too well.
We can hear
Sorry, I
you.
was not audible.
Okay, so quickly, I
Yes,
wanted to
yes.
go back to 2 points. Rajesh, I can hear you now. Yeah.
Right.
Want to go back to this point, Rajesh, you made on real estate at the start of the an upcycle. How strong is this, real estate upcycle going to be? What is your own feel, and how many of you are really bullish and think that real estate could actually, over the next 3 to 5 years, outdo even equities?
Okay. Hard assets or
Rajesh, do you want to go first?
real estate investment through financial assets or just pure hard assets? Real assets.
No, however you want to see it, I mean, you can play it in
Okay.
different ways, but
Right.
for both of which, fundamentally, the real estate cycle will have to look up, isn't it?
Right. No, so we've clearly witnessed an upcycle for the real estate sector during the post-COVID period, and this has also led to a sizable price increase. And this has impinged upon the absorption and launches, especially in the affordable segment, while the luxury segment has continued to grow unabated. I think going forward, it'll be a function of policies for affordable housing, the softening of interest rates, product innovations, REITs, city centers. Now with also this GCC is becoming quite attractive here. Commercial real estate is looking positive. So overall, we continue to remain bullish on real estate as an asset class. Now, how to play it is, is debatable, and it's at least with the ultra HNI sector, many play this through land acquisition and directly buying land. I think many of them have moved away from buying just apartments or commercial real estate into getting into things like real estate funds and REITs, which offer a tax advantage liquidity. And REITs InvITs, by the way,
Right.
is now becoming a significant portion of clients' portfolio, and especially because of what's happening on vanilla fixed income products, alternate fixed income, be it REITs, InvITs, real estate funds, private credit funds. You are seeing a fair amount of interest coming in from ultra HNIs and HNIs. So as an asset class, it will do well. How to play this, we always advise through financial investments and financial products rather than directly.
It's also important to see which part of the chain are you in. So, for instance, Mahalakshmi, let's take maybe close to Mumbai, say Worli, Bandra, and you're having rates of more than 1 lakh rupees per square feet. Now, of course, when an HNI comes in, he buys an apartment of 1 lakh rupees per square feet. By the time some other building comes in at 1 lakh per square feet or whatever, and that building is now stagnant for 3-4 years, the price doesn't go up. But who's making money here? So that's why I said it's very important which part of the chain are you in. But the developer definitely is making a lot of money here. So because at these prices, the profit margins are fantastic, and if the price remains at these levels, I think if you want to make IRR, you need to be on the development side. Now, everybody can't be a developer, but there are funds which are coming in who give you a participation on equity in projects. That is one. Second, on commercial real estate. Again, when you are buying a REIT in the IPO, you're getting 7 to 8%, so you're too late. But if you're in a pre-REIT or you're with somebody who's constructing and then leasing out, your IRR goes on maybe, if you're lucky, 20% plus, or at least a higher double digit. So
Right.
it depends on which part of the chain are you in, and I'm tending towards more initial and development side will give you more returns than being an end user.
So
Understood.
largely the luxury segment, we are seeing a huge amount of interest from a consumption standpoint. I don't think ultra HNIs are looking at it from an investment or IRR. I think
Right.
anyone looking at investment is going through REITs, InvITs, real estate funds, or sometimes directly having deals with real estate developers. By the way, now REIT, InvIT AUM is close to $108 billion. So it's become a significant way for clients to participate, especially on commercial real estate, rather than buying it directly and going through the hassle of maintenance.
So you saw,
Mahalakshmi?
one of the Asia's largest REIT getting listed a month and a half back, Knowledge
Yeah.
Park. And and if you look at those returns, I think post listing also it surprised us with the kind of return it gave.
Yeah.
But we kind of came slightly pre-listing. So if you see the life cycle, I think the way it happens in private equity asset classes, you have a pre-IPO, you have a growth stage, pre-IPO and IPO and anchor and listing. I think the life cycle of the way real assets have got financialized. I think a lot of operating leverage, whether it's cost of capital for the developer, whether it's the formalization of real estate as a sector, whether the current rate environment scenario, it is able to juice in between 13 to 25% return, depending on what life cycle you're covering, because it also has a leverage which is kicking in, giving that return. So I think it's becoming very interesting because, like every other asset class, post listing, there is a mispricing, sometimes overvalued, sometimes undervalued, and there are macro factors, both from where is the asset based, who is the tenant, what is your cost of capital, what is the rate of borrowing, trend in interest rate. Some of these things, if you kind of create a model out of it, you'll keep on getting sweet spots to pick in and drive your return by investing.
Mahalakshmi,
Understood.
uh,
Understood. Yeah.
I think one thing when you look at structural change in real estate over the next 10 years, if that's the kind of period, you have to factor in the fact that Section 54 and 54F being capped is going to put real estate into the back burner. What has India done? Why has real estate done so well? For two reasons. One, because India is a tax sensitive society, and anytime a person sold 100 acres of land from 1 crore, he developed it and got 100 crore cash flow, he would buy more real estate and get all of that tax free in the earlier tax regime when the taxes were high. Now what is happening is 54F and 54 is capped at 10 crores. That implies that anybody who's in the development stage, 54 and 54F don't remain relevant. So most of the money which was getting reinvested generationally in real estate to save tax is out of the window. One. Second, putting a structure in an unstructured market. Today, you go to Gurgaon, sell an apartment, the buyer is going to say cash lily, right? I've seen
Right.
NRIs coming, trying to sell a
Right.
land parcel. You have to have a bodyguard with you, right? That's the kind of, you putting a structure in an unstructured asset class. I have had some REIT funds which were early, and I did the mistake of recommending them to my clients in 2005 to 2015. The IRRs have been 4% when you would have bought an apartment in Mira Road and quadrupled your money. I got only 27% return, right? So when you're trying to, I think we're too early to put strong structures in an unstructured asset, which is driven by several other anomalies which are difficult to speak on live streaming for sure.
Good point. So,
I'll
yeah.
just give you my take, Mahalakshmi. For the ultra high net worth, I feel they should look at commercial real estate. There's a shortage of supply in commercial real estate. For the ultra high net worth for land, you have to be very selective because, like Firoz rightly mentioned, cash has come back. So segments like Alibag or some parts of Delhi are again advisable. The challenge in India has been that real estate has made money for the clients, but real estate funds and real estate through structures has not been profitable. So
Right.
that is why you're much better off playing the ancillary industries which supply to them, and that becomes a easier play than investing directly in these real estate assets. Lastly, on REITs and InvITs, I think it's a very big opportunity. Like Rajesh Yatin has said, the asset class is really opening up, but it's very important that the issuers maintain transparency and are not opaque, because the industry can die a very early death. So any asset here can be priced anyway by a shift in the Excel sheet. And we've seen that previously in the case of InvIT. So it's a great asset class, provided the issuers, which are predominantly real estate developers, maintain transparency and integrity.
Fair enough. Quickly, one last question to all of you. I mean, if you can just give me top 5 asset classes in terms of absolute returns that you expect over the course of this year, and segment it not like equities and debt, but like secondary market, IPO markets, private equity, private debt, real estate, various segments, and so on. Should we start with Rajesh?
So you're saying rank them in terms of return,
Rank,
or actually tell you the kind of returns?
rank them in terms of what you expect in terms of returns,
Okay.
including gold and silver,
Okay. With a 1 year perspective?
with a 1 year perspective.
Okay. So secondary equity, uh, 15 to 18% return, then followed by private credit, alternate credit kind of opportunities, again 13 to 15% returns. IPO, very, very selective, very tough to classify it as an asset class and say, okay, X percentage should be IPO. So no idea, but a good IPO, fairly valued, can give you significant returns over a period of time, but it'll be very, very selective, but not from a asset allocation perspective. Gold, gold, I would still say about a good 10 to 12% kind of return on a 1 year basis. So this would be my ranking. And in the second part, which I mentioned, private credit and alternate, I also include InvITs, REITs, all the so-called credit opportunities.
Understood. Wants to go next?
And sorry, private deals, I missed out. So after private credit would be private deals, stroke international investing, which again can give 18 to 20 odd percent. And then last, gold.
Wow, 20%.
So I will not give percentage allocation, but I'll start with, I think, international markets.
No, my question is not allocation. My question is
Yes.
expectation on
Of
returns.
return. Yes, that's what I was saying. I was starting from there only. I think international markets continues to relatively looks very attractive, and whatever has happened from a attractiveness of valuation, dollar depreciation, home country bias coming in post tariff, all of this looks like a good structural expectation of returns coming from emerging markets. So I would put that number one. I think even in India, I like the growth and pre-IPO private markets a lot. I think the IPO market valuations have got a bit toned down in a sense that there is money on the table. So pre-IPO seems to look at doing slightly better than the expectation on a listed side. Then I would look at REITs and credit. Both looks 15% plus return. I think there is a juice once the rupee depreciation halts. I think there is a room for some rate cut coming in, which will help real assets. Both they are also in a way protect against inflation. There is a yield, and then there is some financialization juice, which leads to a double-digit return. And then I would play, secondary market. I would not be surprised both secondary markets and still gold and ETF. Gold and silver stroke commodities as a basket could deliver a similar return like your listed equities.
Understood. Ashish, Feroz.
Feroz, you want to go or should I?
आशीष सर आपके सुनने के बाद मैं सुनाऊंगा
equity में large cap रहना चाहिए. I think consumption is an opportunity. The consumption stocks, Nestle after such a bad result, stock has still gone up. I think consumption stocks is an opportunity. Just example, doesn't mean necessarily stocks, but like Hero Motors and Maruti and ITC, etc. These kind of stocks, you don't have to go asset class wise. Like you can even look at a PVR. But these are examples, not the stocks which I'm recommending. So equity, I think, should be positive provided you are in large caps and in the consumption basket. Credit funds, I agree with Rajesh. It's an asset class to look at, but there are a variety of funds. Better to go with the more conservative ones, who are focusing on A plus, triple B plus kind of assets. REIT InvITs have just run up in the last 1 month, so I think all listed REIT InvITs should give a single-digit return. Gold, till central banks continue to buy, looks like it's heading towards 6,000. Currently, it's a hold. But like all my colleagues said, if there is a correction, one can look at it. You have to keep a close eye on central banks. China has been the biggest buyer of gold so far. But you don't know what to believe and what not to believe, sometimes when the data comes out. So I would keep a close eye on gold. Internationally, money is moving towards Japan and China. I'm not an expert, but these are the two asset classes US investors are looking at investing. I would definitely keep 10 to 20% cash with me, because if the way the world is going, the way everyday stocks are going up, there is a worry. So 10 to 20% cash is advisable. And tactically, a lot of our US linked businesses saw a sharp correction. So if India does sign a deal, there is a hope, that we will at some point of time sign a deal with them. Then these companies may see a run up. So that's a quick summary from myself.
Understood. Cool. Umang, Feroz.
Feroz, you go ahead.
Yeah, sure. So one is, I personally think that equity, listed equity, is good enough for the next 1-2 years. Anything which can't be valued in a year should not be projected in a year. If I buy anything which is unlisted, I might think that, yeah, IPO jayega, I'll make 500 rupees a share, but then he'll do his IPO at 200 rupees a share, right? So I would say that anything which is going to be a little longer termish, if there's a secondary market like NSE share can be sold for in dime and dozen, so that's separate. So I think secondary market of listed equity is the best asset class. The second is, inside that, there seems to be an equilibrium between mid cap, large cap, and small cap. If that is the case, I would recommend a 60, 20, and 20. A small cap also 20, because India's definition of small cap stops at 500 stocks. Which is about 5,000 crore market cap in NSE 500. So that's second. Third, from a sector standpoint, like Ashish Saab said, consumption is a sector. Seldom does it happen that a sector gets so much decibel, but the past performance is not stupendous. Like defense got some lot of attention, but then if you look at the defense fund's past performance, then you would see 50-60% to rear view mirror mein dikh raha hai. This is the first time you're seeing that a sector which has got some propelling from the government, be it the direct tax cut, the new tax regime, the GST cut, all those structural changes which will give consumption a boost, but the valuations are reasonable. Last 1 year return is not so good. So A, B, C, D, E, in fact, is the sector: auto, banking, consumption, drugs, and renewable energy. These are sectors which you can choose an active fund manager, giving him the larger canvas and not trying to double down on what his task is. But these are the now when it comes to gold and silver, I would say if you are holding debt in your portfolio, that is criminal for long-term monies. In my opinion, there are no 10-year periods where you would be disappointed by equity. So I would say half your debt money could be in gold if it can go into a staggered fashion, because I expect reversals very sharp, if at all any. So you don't have to invest lump sum. If you stagger in 12 months, you will get an average price which you deserve. And from there on, beating debt for precious metal should not be difficult. Whatever the narrative which is governments are buying, the top 7-8 governments have not bought. China has added only about 14% in the last 10 years of its reserves. Who has bought is the smaller countries. The top 10 guys have not added. Only Russia, India has added a little from a 10-year perspective. Who has added is the Azerbaijans of the world.
Japan has also added. Feroz, Japan has added loads.
Yeah, it has added loads. I'm speaking about who has the maximum reserves currently. In the top 10, only Russia, India, and China have added
Okay.
right. And I'm speaking about 10-year holding. I'm not even speaking about last 6 months. Right? Of course, there is 1,000 tons purchase from central banks, but you would see that these smaller countries are purchasing after the Ukraine and the Russia war and their intimidation from the US in terms of their reserves. So coming back, if that trend continues, will it beat debt? I personally think in 10 years, you would see gold and precious metal beating debt and not silver. Coming to REIT and InvIT, my opinion is if you calculate the standard deviation you actually take is more like equity, but the returns, if you calculate the Sharpe ratio, we'll all be on the same page that REITs would fall 5th, 7th, 8th in the category. If you look at both the volatility, it throws up the realized volatility of the REITs is almost about 18%. The realized volatility of Nifty has been 12.2 for the last 1 year. So if you calculate Sharpe ratios, it'll look like you've not got a good risk-adjusted return. At least, of course, the gamut is small as this industry expands. And like Etin was saying, once the industry expands, you will have a larger data to play around with. So that's my take in terms of asset classes and product classes.
Fair enough. Umang?
Yeah. So I just named the 5, as you said, in terms of my order. So first, I think, is secondary market in India. And I did mention about what we're seeing is in many stocks when the results are coming on a decline year-on-year basis and still the stock goes up, it is classic signs of bear fatigue, and that puts secondary market India as, at least for me, number one. Second, I would say, is secondary market ex US, so maybe Asia or Europe. That also we are seeing a lot of probably stocks at maybe many banks currently trade at book value and so on and so forth. So you have a lot of valuation comfort in other parts of the world. So I would say that would be number two. Third, I would like to highlight a sort of product category, asset class called private InvITs. Now, what are private InvITs? Basically, they come into as an IPO, only as a private listing, and then come up with a public listing, say a year or 2 or 3 years later. Now, what happens there is most of the private InvITs come at around a 12% 12% kind of IRR. And when you do a public IPO, they come at around 9 and 10% IRR. So that contraction from 12 to 10 for say a 2044 road asset or a 2050 solar asset or whatever, I mean, that's huge contraction to play between private to public. That's my number three. Number four would be something similar like pre-InvITs and pre-REITs, which are looking at a pre-InvIT, which is looking at a private listing. Very difficult to source for everybody, but yeah, that's probably my number four. And fifth is gold. I'm not mentioning silver, it's gold. But maybe, as all of us agreed, that there could be a time correction or a price correction. And after that, I think the trend resumes. So that would be my fifth.
So, and none of you are proponents or none of you advise Bitcoins or cryptos at all.
No understanding.
I mean, it's not a funny question, because I hear even Jamie Dimon is saying that some part of your money should go into cryptos or Bitcoin. It should be part of your asset allocation. And while we all know history doesn't repeat, it does rhyme. Manish Chokani, I interviewed this week, was saying that gold is like the safe haven of the 50s, of people in the 50s, and Bitcoin is the safe haven of people in the 30s. They are looking at guarding against currency devaluation and debasement through cryptos, while we are looking at the past, at the rear view mirror, and saying that gold is the asset which is going to be our safe haven or insurance. So none of you subscribe to that.
So, definitely, I think the price history, performance, and the belief in gold is where I think the biggest comfort lies. And it's, again, I'm coming back to it's a dollar debasement trade, dollar depreciation trade, natural coming to it's a, we've all somewhere what's happening around the world are challenging the fiat currency nature of debt binging. It's a historical high global debt to GDP coming mostly from West. So some of these things, trends are playing out. We are seeing it, and the Bitcoin is supposed to be the future. It will have to go test of times, and for you to start looking at allocation, and also the regulatory framework and things like that are where allows financial institutions like us whether we can recommend or not. But surely the trend is playing out, and it's been now good 15 years now where Bitcoin has been trading, and now I think what cryptocurrency is almost $2.5 trillion of market cap, still fairly under 1% of financial assets of the world. So there could be some room, but will come with a lot of volatility.
Regulatory wise, cryptos, there's a challenge. You can't get clients to invest, but people who've got portfolios under LRS outside the country, there is some exposure taken through model portfolios, largely client driven, because there is very little research you can do. You're literally backing a couple of big names, asset managers who've got a basket of cryptos, and either blockchain ETFs or crypto currency funds for offshore portfolios become largely client driven.
Mahalakshmi, I think it doesn't pass one litmus test, most people as
Understood.
investors should ideally have. That's a recommended litmus test. Do you understand what you own? Most people I have spoken to who own a crypto are not able to explain why Terra Luna overnight became zero when it was ironically called a stable coin. सब जो crypto की बातें कर रहे हैं, at least if one of them became zero in 2 nights, should that not be evaluated why that happened? If you can't explain this in a simple fashion, how reverse arbitrage was done to break the algorithm, then how do you qualify to pass this litmus test if that was worth a consideration? Know what you own. People don't know what they own. Second, US is a very speculative society. You look at data after data in the 100-year period, you give them a variable which they can speculate on, they will. Today you have NASDAQ ETFs, 3x, 4x up and down, right? Leveraged ETFs, right? So point I'm trying to get to is, if you know, you can own. Second, like one of my neighbor walked up to me and said, Firoz, why don't you buy Bitcoin? Because he was telling me so many times, I said, chal, teri khushi ke liye main ek Bitcoin kharid leta hu, tab 60-70,000 ka. Then after 3 months, he comes back and says, mere crypto chori ho gaye. And he went to Baikala police station to write this report. Can you believe today who's going to protect me? I'm telling you, he tells me मेरा दुखड़ा सुना रहा है कि यार मैं कैसे समझाऊं इसको कहां से चोरी हो गए, कैसे वो लॉकर से चोरी हुए, who is governing the wallet? So point is, there are so many other ifs and buts. So can it become a wealth manager's tool to create value, risk-adjusted return? Currently, no. And I think most people who speak about it should understand this case study of how a stable coin algorithm could have been broken. And today also somebody with a big pocket can exploit a stable currency, Terra USD and Terra Luna were broken. And it's not very difficult. If you have deep pockets, you can break that linkage.
Understood. Nice point, except that I'm not sure whether I agree that US is a more speculative market than India, especially after what we have seen in derivatives here.
No.
And so many other
I'll show you some data.
pockets of
I'll show you some
gambling.
data. We will come on the same page, Mahalakshmi, if I show you the data. For the lack of time, I'm not putting that up.
Okay, no worries. But thank you so much, gentlemen. It was an absolute delight talking to all of you. Thank you for all your insights and sharing what you think about the year ahead. Wish you all a very, very happy Diwali and, of course, a very, very profitable new year. Thank you so much.
Wish you the same.
Thank you. Bye.
Thank you for tuning into Moneycontrol. Stay tuned to Moneycontrol for all the news, views, and market updates.